There's obviously okay, thank you all for coming and taking your seats. I'm now going to shut the doors. So I do apologise awfully for the delay. Strikes obviously affected play in this case. We've got a good turnout, so thank you all for coming. I'm immediately going to pass you on to Jeroen Vermeij, who is the Director of Statistics and Economics at EUROFER, who will introduce himself and some of the work of EUROFER before passing on to Doug Godden, who will introduce the report, which you will of course now find intangible. And again, thank you very much for coming.
Okay, thank you, Charles. Welcome everybody to this seminar, the impact of the European steel sector on the EU economy, which we're hosting this afternoon. As Charles said, my name is Jeroen Vermeij. I'm Director of Market Analysis and Economic Studies at EUROFER. Axel Eggert, who is our General Director, was supposed to do the introductory words, but he couldn't make it because of other urgent business. So I have now the honor and the pleasure to say a few words to you. Well, actually, I would like to start by saying that I'm extremely happy to seeing the faces from Oxford Economics here, because as Charles said, we heard this morning there were delays with the Eurostar, but they made it, and that's very, very good. Oxford Economics may not be a familiar name to you. It is, I think, a familiar name to a lot of companies in the steel sector, and I think in the European industrial scene. They're a leader in global forecasting, in economic modeling, economic consulting. As far as I know, they have offices all around the world. I think they employ some 300 people.
Yeah, 350.
To 200 economists, analysts. When we decided to outsource a study on the impact of the European steel industry on the EU economy, I think there basically was only one name that came to our mind. That was Oxford Economics. So a warm welcome to Doug Godden, who will be doing the presentation, to Gabrielle Morin, who is a business developer,
Yes.
and Ify Pearson. You're
As well.
okay.
Thank you.
Okay.
No, keep on that.
Okay. So before handing over, because I'm not going to say anything about the study, that's not my job. Doug will take that part. Maybe a few words on the quarterly report we are now working on. EUROFER is publishing on a quarterly basis a forecast for the European steel market. I'm not going to give you any hard numbers. Maybe a qualitative impression where we are now and very shortly. I think that the European economy is still doing fairly well. Although since the start of this year, we've been seeing confidence indicators trending down a bit. Now, I think that's to a large extent related to, let's call it growing pains in industry. We've seen quite a sharp acceleration in manufacturing activity and in construction in Europe last year. And actually that led to a reduced flexibility in the supply chain, increasing lead times, orders. And so the industry is really coming at limits in terms of how much more they can produce. So that's actually a very positive situation. Another part of the explanation is also, of course, the fact that there's increasing concern about protectionism around the world. Of course, as a European steel sector, we are extremely concerned about the impact of the Section 232 tariffs, which have been applied by the US government. But apparently it's a wider concern, which is also shared by the manufacturing sector and by other industrial and economic sectors in Europe. For the rest, combined with, I think, a good outlook for the steel-using sectors in Europe, such as the automotive sector, construction, engineering, the outlook shouldn't be that bad. But again, the main uncertainty is clearly at this point again what will happen with trade. Steel imports coming to Europe. We've seen over the period 2013-2017 a 66% increase in steel imports arriving in Europe. That resulted in significant job losses in the sector. Now, if we would see again a very significant inflow of steel imports due to the impact, direct and indirect impact of Section 232 tariffs, of course, that would be disastrous for the European steel sector. However, there's still a lot of uncertainty surrounding Section 232. We have an exemption for 1 month, but nobody knows at this point in time what's going to happen on 1st of May. Well, I won't take much of your time from here. I'm now going to give the floor to Doug. Doug, please go ahead.
Okay. Thank you very much. Thank you, Jeroen. And thank you everyone for coming. And also, I'd like to thank you all for waiting around to hear this presentation. I hope it doesn't disrupt your afternoon too much. Just to say, first of all, a bit about the report which you'll have. First of all, we are looking at the size of the European Union steel sector, and that's across the 22 countries in which EUROFER has members. We'll also look at the resulting impact of those activities on the wider EU economy through different extra channels of demand across the 28 countries of the European Union. And also the report looks at individual country results for all 28 member states, which you'll find in chapter 4 in the report. And so for this presentation, I'm going to start by looking at the industry's own economic activity first. I then want to say a bit about what we mean by the wider economic footprint before talking about the size of that footprint. So just starting with the industry itself, I mean, the industry definition here is simply the basic iron and steel manufacturing. So we're not including things like casting or steel tubes and pipes. It's really very much the sector represented by EUROFER. And you'll see that the value of production, all the numbers here relate to 2016. The value of production was 123.5 billion euros across the EU 28, and that equated to just under 1.9% of all manufacturing production. And just to give that some sort of context, we can see here that this shows the various industries with similar levels. You'll see the basic iron and steel industry. Actually, the value of production is a bit more than, say, clothing and leather manufacturing, for example, or indeed the manufacture of computer equipment across the EU 28. But if we look at how the value of production breaks down, you can see it's sort of slightly unusual by the standards of a typical manufacturing industry. You can imagine manufacturing production splitting into two major cost components and a bit left over for profit. So the two major cost components are procurement of goods and services from other sectors, and then employment costs, which will include wages, salaries, pension costs, social security contributions. And the bit left over on here sort of labelled gross profits, although those gross profits actually have to cover all capital costs of the industry, and then in addition a bit left over for net profits. Now, the gross value added is simply the industry's contribution to GDP, which is a normal net measure of output, and that's the sum of total employment costs, capital costs, and net profits. You can see here that the ratio of total the ratio of total production to the sector's own GVA is around 6.0, and that compares with a typical ratio for manufacturing as a whole of between 3.5 and 4. So you can see the industry is slightly different there, and that has implications further on. So as a result of that, you can see that the gross value added of the industry itself, what we can call the direct gross value added of the industry, is just under 21 billion euros, or just over 1.1% of the GVA of all European Union manufacturing. Now turning to GVA per job, we can see that that is around 7% above the average manufacturing for the EU as a whole, and that partly reflects a sort of capital intensive nature, slightly more than average capital intensive nature of the sector. And it's also 11% or so higher than the average GVA per job across the EU's economy as a whole, including construction services as well as manufacturing. So coming on to what that means for jobs, we can see that the industry employs around 320,000 individuals, and those jobs account for just over 1% of EU manufacturing jobs. And if you look at employment here in context, again, although you may say, well, the 1% or so isn't particularly significant, in fact, it still is more than in some well-known sort of household name industries, including, for example, the manufacturing of alcoholic drinks and of glass products. Turning now to steel industry employment by country, again here Germany is clearly the country with the largest single contribution to jobs, followed by Italy and then Romania and Poland. Now this sort of differs slightly from the contribution to production and GVA, which you'll also find in the report. So here Romania and Poland are first and third and fourth. Germany is always in first place, whatever measure we look at, and Italy second place. But for example, for GVA, I think it's the UK and Austria are coming as third and fourth, and for production, it will be France and Spain coming respectively third and fourth. So the pattern for jobs is slightly different to the pattern for GVA and production. There's also one other way we can look at this, another cut of this, looking in terms of country, and you'll find these details in the country detailed chapter. But basically, the relative impact, the number, the steel industry jobs as a share of all jobs in each country, that is actually relatively highest in Luxembourg, followed by Slovenia and Slovakia. So a slightly different pattern if you look at things on that basis. So let me come on to talk about what we mean by the wider economic footprint. The wider economic footprint basically covers three channels of impact. And the first two are the direct impact and the indirect impact. Now, the direct impact is simply the sector's own contribution, which is exactly what we've just been talking about. The indirect impact is the impact on GVA and jobs that the industry has by purchasing goods and services from other sectors, and that has a knock-on effect throughout the supply chain, throughout the European Union. But the total impact also includes a third channel of impact, which is the induced impact. That is the impact of spending by workers, both in the steel industry and in its supply chain, the impact of their demand on output and activity and jobs in other parts of the European Union economy. Now, when we've done the modelling, it's worth highlighting that we have done it in a more sophisticated way than perhaps may have been done in the past. We use something called the Oxford Economics Global Impact Model. If you just have a single country study, then normally all of your imports will simply be leakage, and therefore there will be no knock-on effect at all. What we've done here is to model all 28 EU countries together with a rest of the world sector. So firstly, to make sure that any transactions between EU countries don't result in the indirect impact being sort of artificially lowered. And then secondly, that actually where the EU countries, say for example, Germany imports some sort of maybe some components from the United States, but the United States supplier in turn imports some of those products in part of its supply chain from, say, France, then actually that feedback effect should be captured, at least in principle, by this new way of modelling, so that we do capture effects further down the supply chain, even where transactions go across the EU, non-EU border and back again. So look at the size of the wider footprint. First, we're looking at the procurement. We can see that total procurement of inputs from other industries, which is essentially the difference between production and GVA, that was around 103 billion euros in 2016. You'll see how that pattern sort of spread across the various different types of industry. Now, that resulted in an indirect GVA impact of around 71 billion euros. And first of all, the difference here is net imports, mostly net imports. There's a bit of some sort of taxes on transactions, which also aren't included in GVA, which also explains some of the difference between procurement and indirect GVA. But most of the difference is accounted for by net imports. And I think here, part of that is the imports of metal ores from outside of the EU. And that also has an effect on the distribution or by sector of the indirect impact compared with the actual first round of procurement. And there are other things affecting that as well, in particular, transactions further down the supply chain, for example, manufacturers supplying the steel industry in turn, buying services from other sectors of the EU economy. You can see here also that while the induced impact is not as important as the indirect impact, it still is quite significant. And again, this shows a sort of quite a different pattern of impact by industry for the induced impact compared with the indirect impact. And the induced impact very much follows the pattern of consumer spending, because it is driven by the consumer spending of workers in the steel industry and in its supply chain. So if we look at what the impact is overall, we can see that actually the GVA is over 127 billion compared with a direct GVA alone of just less than 21 billion euros. And that the industry, although there are only 320,000 people employed in the industry itself, taking the three channels of impact together, that employment amounts to nearly 2.5 million jobs across the EU. Or put another way, another way of saying this is that in technical terms, the multipliers are very high. So, for example, something called the type 1 multiplier reflects the ratio of indirect plus direct to direct only. The type 2 multiplier reflects the total impact, the impact of direct, indirect, and induced, those added up compared with the direct impact alone. Now, typically for a manufacturing sector, the type 2 multiplier for both GVA and jobs might not be very much more than, say, 3, whereas here we have a ratio of 6.2 for GVA, and certainly the 4.5 multiplier for the type 1 multiplier is very much related to the high amount of procurement as a share of total production, which we saw earlier. And the multipliers for jobs are slightly higher, and that's because the productivity in the industry itself, the GVA per job in the industry itself, is a bit lower than it is in the supply chain and the European Union economy as a whole, and therefore a given amount of euros of GVA actually supports more jobs in the indirect and induced channels than in the direct channel. So if we look at how GVA in context, for example, we can see that the steel industry's overall impact is slightly more than that total GVA of the region around Berlin. And the impact for jobs, again, here is more than the Dusseldorf and Köln regions, and indeed more than the whole country of Finland. And now just turning to the jobs impact by sector, again, we can see how the jobs impact is very much spread around the various sectors, that the jobs in the steel industry itself account for only 13% of the total jobs, and the rest are spread across quite a range of manufacturing, construction, and service sectors. Total impact by country, this is maybe not a surprise that the employment impact by country very much fits in. In other words, it's really very much the largest countries where we can see the total impact being the largest. I should just clarify what we mean by the impact by country here. This is the impact of the EU-wide steel industry on each individual country's activity, not the impact on EU activity of the activity of each country's steel industry. I think it would have been possible to do it the other way, but this is what we're looking at for the purposes of this report. And one consequence of that is that even those 6 countries where the steel industry is actually absent or at least negligible, there still is some impact from EU steel sector activity because of these extra channels of impact. And that's sort of shown on this chart here, although again you can see that the sort of various impacts. So this is jobs, total employment impact as a share of all jobs in these countries, and in this case the highest impact, the highest relative impact is in Luxembourg and Slovenia and Finland. So just to conclude, so the the direct impact of the industry, its own gross value added, amounts to just under £21 billion, and that supports 320,000 jobs. But the total value of the gross value of production is 6 times the value of GVA, and that ratio is very high by the standards of typical manufacturing industries. And it does result in these large indirect and induced impacts. And as a result of that, the total GVA impact through all 3 channels is close to 128 billion euros, which is more than the GVA of the Berlin region. And that in turn supports around 2.5 million jobs across the EU, which is 7.7 times the number found in the industry itself. Thank you very much.
Okay. Thank you very much. Thank you.
Yes, fine.
Yeah, thank you very much, Doug. I can imagine there are some questions from the floor. We've got a variety of people here with economic background, market analysts. So please go ahead. Should you have a question, please tell us who you are, where you come from, and then address the question to Oxford Economics.
And give me time to get the mic.
Yeah, that's it. Thanks. Very close.
Yes, indeed. You have to speak.
Yes,
Yes, Alfonso Hidalgo from UNESID, the Spanish Trade Association. And I have 2 questions. One of the first one is, how do you consider outsourcing done inside the mills is considered, any process which is normally part of the production process, but is carried out by a third company outsourcer? Do you consider it direct, or is it inside the type 1 multiplier?
I think it would very much depend on how it is classified to the NACE classifications. If it is something that is fundamentally iron and steel, basic iron and steel production, then that would be included. I think where the difference may be is if there are certain sort of services, like related processes, which are outsourced, may once have been counted as part of the direct impact simply because they were captured in the statistics. That's what the firm did, and the firm was classified to the steel sector. So in this case, the outsourced industries, unless they are, if there's sort of service activities related to steel, they'd be captured in the indirect rather than direct. So it's possible that some outsourcing will increase the indirect at the expense of the direct, but the overall total impact should still be, the total of the 2 impacts should still be the same.
And the second question is, in some other, it makes sense, everything you have told makes sense, but in some other studies, you see that the jump from the type 1 to the type 2 is bigger. So you have a big jump for the type 1 and a smaller jump from the type 2. And I've seen some other studies, I think the German association did something. Now we had a different...
Because of higher pace in Germany than elsewhere. Higher wages.
Yes, yes. I mean, I think the induced impact is still significant, but as you say, it's sort of relative to the indirect impact. The indirect impact is the most. The indirect impact is the biggest jump, and I think that may well perhaps reflect the, as I said, the wages, particularly in maybe some of the Eastern European countries, included in the study, may be a bit different.
From Marcus. I was just wondering, I mean, I wanted to sort of push it to talking about the US, Mr. Trump, and so on. But in terms of the policy debate, I had two questions of the threat of tariffs. This looks at the into the past, but what kind of threat would you see from having done this analysis from US tariffs in terms of trade diversion and price? And then these benefits, obviously, they're very clear. They're very strong figures for the whole EU economy. Do you feel policymakers in Brussels are aware of that? Because there's a traditional group of countries which are quite pro-free trade, and as we come to very crucial point in time, safeguard measures, for instance, this might play into the debate, I suppose.
Yes, I mean, hopefully this will make a useful contribution to the policy debate. I mean, I think in terms of the first question, it does. Well, we're yet to see whether there'll be some sort of exemptions from that. If they go ahead as originally planned, then I think there'll be. You need to look at what is the cost of the tariff relative to the total value of production. My understanding is that won't be that significant. So it may be that the initial impact may not be as perhaps alarming as some people may suggest. I think there is a danger that if this sort of escalates into a wider trade war, then the impact across many sectors could be significant. I think that will be something that the policymakers do need to be looking out for. And then on the general impact, yes, as I say, I think there are. I mean, I'm not involved in the sort of policy work as such, but hopefully this will make an important contribution to the debate. If policymakers in Brussels aren't aware of the contribution made by the sector already, then hopefully this will clarify matters a bit more.
Maybe I can add something on that. If you look at the period 2013-2017, and I mentioned that already, we saw an increase of 66% of imports coming to Europe from third countries. Over the same period, there were 50,000 jobs they were destroyed. Last year, imports were flat due to an increase in the first half and a decrease in the second half. But if you look at employment numbers for 2017, which we are now collecting, the picture is not yet fully complete. But in 2017, there was again an increase, the first increase in employment, a very modest one, in employment. So there's definitely a very clear relationship between what's happening with imports, steel imports coming to Europe, and the impact on employment in the sector. So we have a very big concern that particularly the diversion of imports originally shipped to the US will end up in Europe and will destroy jobs. That's I think a certainty we have to live with.
Is there a question over here?
Hi, I'm Daniela Floro from the Italian Steel Association. I find this study very interesting, and I would like to thank you, Jeroen, for this occasion. I would like to ask you whether there are studies in other countries in the steel sector, if, for example, Oxford Economics ever run a similar analysis in the steel sector for other extra-UA countries, just to have a matter of comparison. I think that it could be a good parameter if we can compare the European result with the one of other extra-UA countries, and probably EUROFER would can make more studies on this. But just to understand if you have a comparison of these numbers with other steel sectors in extra-UA countries or with other industrial sectors around Europe.
We've done quite a number of studies, mainly on single country, the impact of, say, sectors in single countries. I don't think we've done anything quite on this scale, so it's a bit difficult to come up with some comparisons.
And in terms of the multipliers, there has been a study for Germany, and I think the multipliers which Oxford Economics found for Germany are actually quite close to what, I don't know who did the German study, but I think it was, well, Boston Consultancy or something, but they are quite close. So.
They are from World Steel Association. I'm sorry for being a bit late. I have a similar question. Actually, it would be interesting to see how this multiplier that varies across different industries. And that's cross-sectional comparison is interesting. And also, I wonder this multiplier effect, in fact, how it evolved over time. It has become bigger or smaller, even within years. So kind of time series comparison, if you can shed some light on this.
Yes. So first of all, I mean, I think there's quite a wide range of sort of multiplier impacts across industries, and it does. Sometimes it also depends on the size of the industry. So in some ways, if the industry is really a really small industry, naturally its multiplier effect can be quite significant because it's buying a lot of things in. So I think the steel industry is unusual, and it is actually quite a large, for the size of the industry to have this quite larger multiplier impact. And I think that for a typical industry that may be the same size as a steel sector, you might expect a typical multiplier for a manufacturing sector to be around maybe 3, probably not much more than 3. And I think that, and then for, say, another parts of the economy, apart from retail, which is a special case, but for other service sectors, you're looking at lower multipliers than that. So I think the multiplier of 6 for GVA and over 7 for jobs is very high. As for how they move over time, I'm not sure there's a real answer to that. I don't think, my expectation is that the multipliers will sort of tend to be pretty stable over time, apart from what we discussed earlier about things like outsourcing may have a sort of more like a sort of statistical effect. But I think the real effect is very much, I think we tend to think it will be stable over time. And I think one of the problems also about comparing multipliers over time is that the way you have to work them out is that the multipliers themselves depend on a set of statistics, something known as an input-output table, which looks at the transactions between different industries. And these input-output tables aren't produced every year. They only come out every couple of years. And so therefore, actually the comparison over time becomes more difficult because we're sort of using the same. If we did a study last year or next year, the chances are we'd have to use the same input-output tables we use this time. And that will therefore keep the ratios very much the same. But I think the reason why the input-output tables don't come out every year, that is simply it's a reasonable assumption to say that the relationship between the industries is fairly stable over time, and that therefore the multipliers will also be fairly stable over time.
Sorry, the multiplier usually should change if there is a technological change, because the input-output table usually change very much across 5 years. If we have a shock under a technological point of view, I think, for example. So I think that this multiplier might remain stable if there is no technological shock, I suppose.
Yes, I think that's right. Certainly, yeah, it is possible for multipliers to change, and I think that there are changes in the structure of the industry, maybe sort of changes in use of, automation rather than use of labour. Obviously, the GVA component includes the company's own labour, and if there's a sort of gradual shift from being labour intensive to a more capital intensive industry, where the sort of components are brought in from outside, then I think that could have a shift on the multipliers, that the direct impact would sort of fall and the indirect impact would increase. That would increase the multipliers over time, and it may be, for some industries that may be the case.
But if we think in general to the European economy and the fact that the European economy is a mature economy, can we say under the policy point of view that this multiplier can represent correctly probably the relationship in the last 10 years, 15 years? If we suppose that there is no technological shock that has changed the structure of the input-output table,
yeah,
and we consider that the European economy is a mature economy, so it's not under development, probably we can extend the period for which we can say that these numbers are representative.
Yeah, yes, that's right. I mean, I think that certainly we can probably look back, say, 3 or 4 years and forward 3 or 4 years and say that the multiplier will be very similar, and that the multiplier, it is a stable enough concept to be able to base policy on. It's not something that's going to jump around from very much from one year to the next.
Okay, thank you.
Well, Peter Jusen from Tata Steel. I find that question by Naya a very important one. The question, how do these multipliers compare to the other sectors that you have within manufacturing? Do you have any, you make some qualitative statements on that, but do you have any documents on that out in the open, public information?
There may, on the Oxford Economics website, there will be some, there are a lot of studies which will be of here is the impact of this company or this sector, and normally have the multipliers, if not made explicit, they will be implicit in the numbers which will be in those sectors, and there's a wide range of studies. What I would say is that most of these studies, a lot of the studies are single country studies where I think that the multipliers may tend to be a bit smaller because there's a lot of leakage, whereas for the EU as a whole, where the leakage through imports is rather less, and so therefore this multiplier may be greater than that for a typical country specific sector. But there should be on the Oxford Economics website, there will be a number of studies which I believe are in the public domain, and there will be hopefully you'll be able to see a range of multipliers.
Thank you.
Hi, I'm Ivan again. I am now curious if there has been any assessment of non-quantitative impacts. Like here we are only looking at number of output or employment, but having industry within the economic area, would it have any other aspects of, let's say, some technological development or some local aspects related to the value chain? Is there a way to capture this, or this study could complement some non-quantitative, but some, I don't know how to put it correctly, but something related to, say, delivery joint
Innovations, maybe.
Yes, I mean, so this study's sort of been, I suppose, relatively narrow in terms of simply looking at the sort of demand side impacts alone. And some of the other studies we do will look at the contribution to the environment or innovation and R&D, contribution to skills. Maybe, I mean, one of the reasons that the steel industry exists is to sort of help, say, it's a good input into things like construction and maybe vehicle manufacture and so on, which actually have an impact on people's living standards. So again, looking at what is the impact of the sectors which use steel and how many jobs do they supply, but also what is the value of, what is the ultimate value of the houses that are supported by steel. So in a way, this just looks at one dimension of the benefit of the steel industry, and there are many other dimensions of those benefits. And that is the sort of work which Oxford Economics is able to do.
Hello. Thank you very much for this interesting study. I kind of found it that it's a little bit static in time, and as we are, I'm working for government affairs, and we are looking forward. So I was wondering, I don't know if that's the remit of the study, but in your view, if we are doing the same impact of the European steel industry in 2030, how would that look like, and what would be the major changes that will impact?
Well, I think looking ahead, I mean, I think that we do have some of my colleagues who work on industry forecasts. And I think the forecast is that the European steel industry is sort of going to be growing over the next year or so, and then will sort of grow, but maybe at a more slower pace. What I think is fair to say is you'll probably expect the European steel industry, maybe the share of total global output will probably gradually decline over time. That is certainly what the Oxford Economics long-term industry forecasts show. But there will still be growth nonetheless, and it won't actually be contracting in absolute terms, at least not in terms of GVA. It may be that obviously the productivity growth may lead to perhaps it becoming less important in terms of jobs.
this is Jen from McKinsey. May I ask you that do you also do research about other metal, for example, the copper or aluminum? And do you do some also computation research of different metals?
I mean, on certain the other sectors, I haven't really involved in. I mean, in principle, we can do studies of almost any sector. We haven't done involved of any of the other sort of non-ferrous metals, but there are in the Oxford Economics industry forecast. If we're talking about growth over time, then there are some. Oxford Economics does produce forecasts of the basic metals industry broken down into the various components, so ferrous metals and non-ferrous metals and casting. So then there should be some information on our Oxford Economics website about that. So.
Doug, I was a bit puzzled by by Romania, the very high employment figures. Do you have an explanation? Is it simply a relic of the old communist times that there were a lot of people employed by industry that didn't change, or what do you think?
It's not really. I mean, obviously the impact of the Romanian GVA is not especially high. So it is to do with the ratio of GVA per job. So it may be that yes, it's sort of unusually low. One thing maybe we need to be careful about the statistics in the sense that the GVA and the job statistics come from two different sources, and therefore they may not be precisely and consistent with each other. Another thing about the Romanian GVA is that Romanian GVA itself does seem to be depressed by a sort of lack of profits that's shown in the industry. And if you take the ratio of the value of production to jobs in Romania, it's not so much outside of the sort of normal range that we found.
Any other questions? No? Okay, well, in that case, I would like to thank you all for coming. I appreciate it very much, and I'm sure both Doug and Jeroen do too. I don't think you're running off immediately, so if anybody wants to ask a question one-on-one, I think I'd be happy to answer